Imagine for a moment the world without money as we know it. A quiet street, a busy marketplace, the sound of voices trading not with coins or bills, but with promises, trust, and expectation. From the earliest days, money has not only been a tool, it has been a mirror of our hopes, our greed, our fears. It rises when we believe in tomorrow, and it vanishes when that belief collapses. Tonight, we open the files. Stories of markets through the centuries. Stories of moments when fortunes disappeared, empires stumbled, and the very meaning of wealth seemed to dissolve into thin air. This is the Capital Files, and this is the story of the day money vanished. History has many faces, but finance, perhaps, is its most restless one. The tale we will wander through tonight is not one story, but many. A pattern that returns again and again, across centuries, across oceans, across currencies. It is the story of crashes, the day when belief breaks, the day when numbers lose their meaning and silence falls over once roaring markets. You don't need to be an investor or a banker or even someone who studies economics to understand this. You only need to close your eyes and imagine the sudden shift from confidence to panic, the hum of a crowd turning into whispers, the feeling that what was certain yesterday no longer exists today. Every generation has known it, and every generation has sworn they would never forget. In this journey, we'll walk together through the frozen canals of Amsterdam during the Tulip Mania. We'll stand among the crowds in London as the South Sea bubble inflates and bursts. We'll wander the crowded streets of New York in 1929 as ticker tape flutters to the ground like falling snow. We'll pause in the fluorescent glow of the 1980s on a Monday forever remembered as black. We'll cross the oceans to Asia in the late 1990s, where currencies collapsed and nations trembled. And we'll relive, gently and slowly, the autumn of 2008, when banks fell and the world itself seemed to teeter. Each of these stories is unique, and yet, each one is familiar. It is not the numbers that matter most, but the rhythm of belief and disbelief, the rise of hope, the crash of fear. As you listen, perhaps drifting into thought or into sleep, notice the pattern. Notice how markets, for all their complexity, follow a human heartbeat. Fast when we chase dreams, slow when we lose trust, and always, eventually, returning again. And so, we begin a journey through history's great financial vanishing acts. Amsterdam, winter of 1637. The canals lay frozen under a pale sky, the lamps glowing faintly against the dark chill. Merchants gathered in taverns, where the warmth of fire met the cold reality of speculation. On their tables lay not coins, but slips of paper, contracts, promises, dreams. At the center of it all was not gold or silver, but a flower, a tulip, a bulb buried in the earth, yet somehow raised to a value beyond houses and ships. The rarest tulips, striped, marbled, kissed, by colors as though painted by the hand of God, commanded fortunes. The price of a single bulb could equal the price of a canal house, or the lifetime wages of a craftsman. Imagine the carpenter, whose days were once measured in the rhythm of hammer and saw. He stood in the tavern, rough hands trembling as he held a contract for bulbs worth more than his workshop, more than the roof above his family. He dreamed not of wood and nails, but of tulip beds he might never plant. Picture the sailor, hardened by storms and salt air, home from months at sea. His pockets carried the wages of dangerous voyages, but instead of food or shelter, he wagered it all on tulip contracts. He trusted that in his absence, the bulbs would bloom, not in gardens, but in value. And see the nobleman, already master of land and servants, leaning close to his peers in candlelit halls. Their whispers spoke not of governance, but of petals. Each one believed they could double their estates before spring's thaw. Even bakers, their aprons dusted with flour, found themselves bargaining over bulbs. In kitchens, children overheard their parents dreaming of fortunes sprouting from the earth. The tulip was no longer just a flower, it was destiny, a key to wealth. But whispers of doubt began to spread. Beneath laughter and toasts, some voices trembled. What if the market faltered? What if, come morning, there was no one to pay more? The illusion was fragile, and everyone knew it. That day came suddenly. At a routine auction, buyers failed to appear. Sellers looked around in confusion, then in panic. One by one, offers dissolved into silence. The chain of faith was broken. Fortunes vanished in an instant. Families who thought themselves rich woke to find only worthless slips of paper. A carpenter's dream of expansion dissolved. A sailor's hope for land disappeared. A baker's ovens went unbought, and noblemen, once proud, stared at papers that mocked their greed. Amsterdam remained cold that winter. The canals were frozen, and the city itself seemed frozen in disbelief. The tulip, once a symbol of wealth, now stood as a reminder of folly. The first great bubble had burst, the first great crash, and with it, a lesson. Markets are not built on goods or gold, but on faith. And faith, once lost, is harder to restore than any treasure. London, 1720. The city hums with a restless energy, as though the very air is charged with possibility. In crowded coffeehouses, smoke curls toward the ceiling, while voices overlap in hurried tones. Tables creak under the weight of newspapers, quills, ledgers, and cups of dark brew. This is where fortunes are made, not on the docks or in workshops, but in the world of paper promises and speculation. The South Sea Company was at the heart of it all. Founded on the promise of lucrative trade with the Spanish colonies, it offered visions of unimaginable wealth across oceans. Though its actual trade was meager, the dream was powerful. Investors believed. And why not? Shares soared, fortunes multiplied. And from merchants to noble families, even members of parliament and the king himself, no one wanted to be left behind. The mania was contagious. Each week seemed to bring a new scheme more dazzling than the last. One company promised to draw silver from lead, another to harness perpetual motion. There was even a proposal that became famous in its absurdity, raising money for an undertaking of great advantage, but nobody to know what it is. People lined up anyway, their hands clutching coins, desperate not to miss what might be the next fortune. Picture a tailor, his fingers calloused from years of needle and thread. For decades, he had stitched garments for the wealthy, earning modest wages. But now he sat in a coffee house, a share certificate spread before him. For the first time in his life, he imagined himself not just a craftsman, but a gentleman investor. He believed that in a matter of months, perhaps weeks, he could rise above his station. Across the city, a widow clutched her small savings. Her husband, lost at sea years before, had left her with little but a cottage and hope for her children's future. Persuaded by neighbours and charmed by gentlemen who spoke of endless riches, she exchanged her coins for South Sea shares. She believed she was securing safety for her family. She believed in the promise, and in Parliament itself, ministers whispered to one another as they scribbled orders for yet more shares. It was said that even the king and his mistresses had invested heavily. The company's leaders boasted of endless expansion, and the stock price climbed higher, doubling, then doubling again. Londoners spoke of little else. Coffeehouses overflowed. Ordinary tradesmen rubbed shoulders with noblemen, all dreaming the same dream. But beneath the optimism lay deception. Insiders knew the company's trade was negligible, its profits overstated. They manipulated prices, selling high while the crowd bought blindly. The fever of speculation outpaced reality. And in time, reality struck back. The first cracks appeared quietly. A few cautious voices muttered that profits did not match promises. A handful of investors tried to sell, only to find fewer willing buyers. At first, it seemed a small matter, but soon, whispers turned to shouts. Fear spread, and like dry timber catching flame, Panic raced through the city. In days, prices tumbled. The tailor, who once dreamed of rising in station, returned to his shop penniless. The certificate he once admired, now worthless. The widow, who believed she had secured her children's future, found herself ruined, her savings gone in a tide of broken promises. In Parliament, shame spread as members who had enriched themselves through the mania-faced public outrage. Riots threatened in the streets as angry investors demanded answers. When the dust settled, Britain was left with wrecked fortunes and shattered trust. Confidence in markets was badly shaken, and the scandal reached to the very heart of government. Laws were passed to curb speculation, early seeds of financial regulation. The South Sea bubble had revealed how fragile trust could be, and how dangerous unchecked greed becomes when dressed in respectability. The lesson lingered. Markets could lift men and women to dreams they had never known. But markets, when built on whispers and illusions, could just as easily cast them down. London had learned painfully that speculation without substance is a house built on sand, and no matter how grand the promises, such houses cannot stand forever. New York City, October 1929. The city pulsed with the rhythm of the roaring 20s. Jazz spilled from speakeasies, radios filled apartments with music and news, automobiles choked the avenues, and skyscrapers climbed higher each season. For millions, it felt as if prosperity would never end. Wall Street, in particular, was alive with a feverish optimism that seemed unstoppable. The stock market had become the great ladder of dreams. Ordinary Americans, who only a decade before had little to do with investments, now found themselves opening brokerage accounts. For as little as $10 down, one could buy on margin, borrowing the rest and gambling on tomorrow's gains. A mechanic could become a shareholder. A school teacher could own a piece of industry. A housewife might dabble in stocks between errands. The market promised a share in the American dream. Picture the school teacher, carefully saving from her modest salary. Each month, she purchased more shares, telling herself she was building not only her future, but perhaps the chance of sending her children to college. Imagine the mechanic, wiping grease from his hands at the end of a long day, proudly, announcing to his family that he was now an investor, not just a laborer. Families gathered at dinner tables, boasting of how their small investments had doubled, even tripled. The market ticker, endlessly rattling, became the heartbeat of a nation. But prosperity built on borrowed money is fragile. The first tremors appeared quietly, in falling steel prices and slowing auto sales. Yet most dismissed these signs. How could the boom end? The newspapers spoke only of record highs, and brokers urged everyone to stay the course. Then, on October 24th, 1929, Black Thursday, the illusion began to crack. Crowds formed outside the stock exchange. Inside, brokers shouted frantically, trying to sell before prices fell further. The ticker lagged, spitting out numbers already outdated. Panic was palpable. Outside on the sidewalks, men and women clutched newspapers, reading with wide eyes as fortunes vanished in minutes. Some clung to hope, believing the market would recover, but the downward spiral only deepened. The following week brought Black Monday, then Black Tuesday. Billions in value evaporated. Investors who had borrowed on margin faced ruin. Banks began to totter. Confidence dissolved. And in homes across the country, ordinary people felt the ground shift beneath their feet. For the teacher, years of careful savings were gone. For the mechanic, the pride of being an investor turned into shame as debts outweighed earnings. And for countless families, the dream of prosperity vanished overnight. The market's collapse was only the beginning. The Great Depression had arrived. Factories closed as orders dried up. Farmers already struggling faced drought and the merciless Dust Bowl winds. Crops withered, cattle died, and families abandoned their land in search of work. In cities, bread lines stretched for blocks. Men in worn suits stood silently, bowls in hand, waiting for soup that was often their only meal of the day. Children grew up too quickly, their laughter dimmed by hunger. In makeshift shantytowns known as Hoovervilles, families huddled under tar paper and scrap wood, their possessions piled in wagons pulled by weary horses. The Depression was more than numbers. It was hunger gnawing at bellies, fathers walking miles to search for work, mothers stretching every scrap of food to feed children. It was the sound of silence at dinner tables where hope once lived. For a generation, it shaped memory, leaving scars that endured long after recovery. The government, at first hesitant, began to act. Under Franklin Roosevelt, the New Deal sought to rebuild confidence. Public works projects provided jobs. The Glass-Steagall Act sought to separate banks from speculation. Social Security offered a safety net. Slowly, painfully, the economy found a path forward. But trust in markets was never again so naive, so blind. The Great Depression was a lesson written in hardship, that unchecked speculation can unravel a society, that optimism without foundation can turn to despair. It reminded the world that markets are not abstract machines, but human systems, vulnerable to fear, greed, and the weight of hope itself. And as America struggled through the 1930s, other nations watched and learned. The Depression became a global warning. Prosperity must rest on more than paper dreams, and when trust vanishes, it can take a generation to return. The 1980s glowed with fluorescent light and optimism. Wall Street buzzed with the sound of telephones, the clicking of keyboards, and the shouts of traders. Across the globe, finance was modernizing. Computers had begun to weave their way into the fabric of markets, replacing chalkboards and handwritten ledgers with glowing screens and coded algorithms. Many believed the new technology would prevent the mistakes of the past. With portfolio, insurance, and computer-assisted trading, they felt protected, shielded by mathematics and speed. But optimism can be a fragile shield. It was October 19th, 1987, a Monday. The day began like any other, with traders sipping coffee and scanning newsprint. Yet a sense of unease lingered. In the weeks before, markets had already shown signs of strain. Rising interest rates, tension in the Middle East, the falling dollar, the kind of headlines that might worry investors, but never enough to imagine catastrophe. As the opening bell rang, prices began to fall. At first, it seemed a correction, nothing unusual. But then the computers, programmed to limit losses through automatic selling, triggered wave after wave of orders. Each sale drove prices lower, which in turn triggered more selling. A feedback loop, invisible and relentless, began to unravel the market. On the floor of the New York Stock Exchange, chaos erupted. Traders pressed phones to their ears, shouting orders that went unfilled. The giant price boards flashed red, numbers tumbling so quickly that even seasoned brokers could not keep pace. The ticker tape lagged by hours, unable to record the avalanche of trades. Men and women, veterans of decades in the market, stood frozen in disbelief as billions vanished before their eyes. Picture a young broker, fresh to the floor, who had only known markets that rose. His excitement at landing his first major clients turned into panic as he watched their portfolios collapse in real time. Or imagine an older trader, hardened by the memory of 1973's oil crisis, now powerless as his carefully built accounts shrank by half before noon. Across the country, ordinary investors dialed their brokers, only to hear frantic voices or silence as lines went dead. By the end of the day, the Dow Jones Industrial Average had fallen more than 20%, the largest single-day percentage drop in history. The shock reverberated far beyond New York. In London, Tokyo, Frankfurt, and Hong Kong, markets followed suit. Billions of dollars of value evaporated in less than 24 hours. Newspapers rushed to print extra editions. For a world newly bound by technology, panic spread faster than ever before. And yet, unlike the Great Depression of 1929, recovery came swiftly. Within months, markets regained much of what was lost. The Federal Reserve, under Chairman Alan Greenspan, stepped in quickly, offering reassurance that liquidity would be maintained. The government and regulators studied the causes, searching for ways to prevent a repeat. Circuit breakers were introduced, mechanisms to halt trading when declines became too steep, too fast. The lesson was clear. Technology could magnify panic, but confidence, once carefully restored, could heal. For those who lived through Black Monday, the memory was searing. The young broker, who had nearly quit, would later tell his children of the day he learned humility. The older trader would mark October 19th on his calendar each year, a reminder that no amount of experience can guard against the unexpected. And for millions of investors across the globe, it was proof that even in an age of computers and models, markets remained deeply, profoundly human. Black Monday was not the longest crash, nor the most devastating in its long-term effects. But it was a warning that no system is foolproof, and that in moments of fear, machines can amplify human panic rather than calm it. It showed that in the end, trust and patience are still the true foundations of stability. In the mid-1990s, Asia shimmered with promise. Cities like Bangkok, Seoul, and Jakarta rose with towers of glass and steel, monuments to growth that seemed unstoppable. Economists called them the Asian tigers. Their economies boomed with double-digit growth, foreign investment poured in, and an air of invincibility lingered in the streets. From bustling night markets to gleaming office towers, it seemed as though a new era of prosperity had arrived. But prosperity, when built on fragile foundations, is more delicate than it appears. The crisis began in Thailand. For years, the Thai baht had been pegged to the US dollar, encouraging borrowing and investment. Banks and corporations took on massive debts, much of it in foreign currency. Real estate soared. New skyscrapers climbed into the sky, half-finished skeletons promising futures of commerce and wealth. Yet beneath the surface, cracks widened. Exports slowed, debt mounted, and speculation swirled. On July 2, 1997, the Thai government announced that it could no longer support the baht's fixed exchange rate. The currency collapsed. Investors panicked. In a matter of days, billions fled the country. The ripple spread outward, crashing into Malaysia, Indonesia, South Korea, and beyond. Asia's miracle became a nightmare. Picture a Bangkok shopkeeper who had borrowed to expand his small stall into a promising storefront. One week, he was dreaming of growth. The next, his loans had doubled in size as the baht plummeted. Or consider a Korean factory worker, once secure in steady wages, now standing in lines as his company folded under the weight of dollar-denominated debts. In Indonesia, entire families watched their savings evaporate, their rupiah bills losing value by the day. The pride of rising middle classes gave way to fear and hunger. Governments turned to the International Monetary Fund, IMF, for aid. In exchange for billions in emergency loans, nations were forced to impose austerity measures, cutting spending, raising interest rates, closing banks. These policies, meant to restore confidence, often deepened the pain. In Indonesia, protests erupted. Students filled the streets shouting for change. In South Korea, families collected gold jewelry and wedding bands, donating them to the government to help repay national debts. It was a time of sacrifice, resilience, and anger. For many, the crisis was not only financial, but deeply personal. A young couple in Jakarta, who had just moved into their first apartment, found themselves unable to pay rent. A Malaysian farmer saw the cost of imported fertilizer skyrocket, while the price of his crops collapsed. Across Asia, millions who had felt secure just months earlier suddenly faced poverty. The recovery, though slow and uneven, did come. By the early 2000s, many economies stabilized. South Korea rebuilt with remarkable speed, fueled by reform and resilience. Thailand and Indonesia, though scarred, eventually returned to growth. But the memory lingered. For millions, the crisis was a lesson etched in hardship, that rapid growth can disguise fragility, that globalization can cut both ways, and that confidence, once lost, takes years to rebuild. The Asian financial crisis revealed how interconnected the world had become. A fall in one market could topple others thousands of miles away. It showed that prosperity without balance is as precarious as a skyscraper built on shifting sand, and it reminded nations that financial storms, once unleashed, do not stop at borders. The early 2000s carried an air of confidence. The internet had blossomed, technology surged, and housing prices climbed steadily, year after year. In suburban neighborhoods, new homes stretched across landscapes once filled with fields. Banks advertised easy loans, assuring families that ownership was within reach for everyone. No money down, the billboards promised. Adjustable rates, the contracts whispered. It seemed prosperity had been democratized. But prosperity built on excess debt and fragile promises is rarely secure. At the heart of it were mortgages, bundled, repackaged, and sold as complex securities. Wall Street called them collateralized debt obligations. To most, they were simply investments stamped with AAA ratings, considered safe as government bonds. Yet inside, many were filled with risky loans. Adjustable rates ticked upward, and suddenly families found themselves owing more than they could pay. Picture a young couple in Ohio moving into their first home. They imagined barbecues in the yard, children playing on the grass. For a while, it was real, but soon their mortgage payments ballooned. Layoffs came. The dream curdled into fear as foreclosure notices arrived. Across the nation, stories like theirs multiplied. Families packed belongings into cardboard boxes, leaving behind not just houses, but hopes. On Wall Street, banks and investment firms assured the world that everything was fine. Yet behind the curtain, they scrambled. Lehman Brothers, a titan with more than a century of history, wavered under the weight of bad debts. In September 2008, it collapsed, sending shockwaves through the global system. The unthinkable had happened. A giant had fallen, and panic raced like wildfire. In trading floors across New York and London, silence fell as screens glowed red. Trillions in value evaporated in weeks. Credit froze. Companies that relied on borrowing found themselves paralyzed. In Detroit, automakers begged for lifelines. In Europe, banks teetered on collapse. Around the globe, nations felt the aftershocks. Governments intervened. In the United States, the Federal Reserve and Treasury poured billions into bailouts, seeking to prevent a total implosion. Programs like TARP, the Troubled Asset Relief Program, were launched to stabilize banks. AIG, once thought invincible, was rescued with taxpayer funds. The phrase, "too big to fail," entered the common tongue, a grim recognition of how entangled finance had become with daily life. The crisis was not only about numbers, it was about people. A retiree who had trusted her pension watched it shrink, forcing her back into work. A small business owner, once secure, shuttered his shop after credit lines vanished. A factory worker in Spain joined millions unemployed, carrying the weight of a collapsed housing bubble in his country. The pain was human, stretching across borders and cultures, and yet, from the wreckage came reform. Governments strengthened regulations. Banks were forced to hold more capital. Stress tests became common. The Dodd-Frank Act in the United States sought to rein in risk. Slowly, confidence returned. Markets recovered. Housing stabilized. But scars remained. Scars on balance sheets, on careers, and on the psyche of a generation. The global financial crisis was a mirror held to modern finance. It showed that complexity can conceal fragility, that greed can masquerade as innovation, and that trust, once lost, can take years to rebuild. It reminded the world that the economy is not an abstract machine, but a network of lives, bound together by choices and consequences. For those who lived through it, 2008 was a reminder that prosperity cannot be sustained by illusion. And for those who look back, it is a caution that vigilance must never fade, and that even in the brightest times, shadows linger just beyond the light. Each of these stories is unique. A flower in Amsterdam, a company in London, a stock exchange in New York, a computer program in the 1980s, a currency in Asia, a mortgage in America, and yet, each one is familiar. It is not the numbers that matter most, but the rhythm of belief and disbelief, the rise of hope, the crash of fear. As you listen, perhaps drifting into thought or into sleep, notice the pattern. Notice how markets, for all their complexity, follow a human heartbeat, fast when we chase dreams, slow when we lose trust, and always, eventually, returning again. Markets will rise, markets will fall, but history remains, and its lessons are always waiting for those willing to listen. This has been the Capital Files, and this has been the story of the day money vanished. If you've stayed with me until now, thank you. I truly appreciate you taking the time to explore history's twists and turns with me. If you enjoyed the journey, don't forget to tap like and subscribe so you don't miss the next chapter. And I'd love to hear from you in the comments. Let me know where in the world you're watching from. Until next time, this has been the Capital Files.